It was another choppy session for equities yesterday, fairly chunky losses on Wall Street, with the tech sector again leading the downside, the Nasdaq down by almost 2%. And that, of course, puts both the S&P and the Nasdaq on track for their first weekly declines in 4. But again, it was a day where there wasn't really an obvious sort of smoking gun or catalyst behind the downside that we saw in the equity space. I think it's more just a reflection of how sentiment appears to be somewhat more fragile at this moment in time than it was back in October. Let me be clear, of course, I still think that the fundamental bull case is a very, very solid one indeed. Earnings growth has been resilient throughout earnings season. Yes, we've seen aftermarket declines in a number of these highly valued equities, but that's probably a reflection of the market's bar being so high that it was almost impossible for the firm to meet those expectations, as opposed to the earnings themselves being subpar, because earnings have been very, very solid. At the same time, the underlying US economy is still resilient. I know there were concerns over the October Challenger Grey layoffs figure yesterday, which was its highest level since March. That is a very, very volatile series, though, and if you look at things like state level initial jobless claims, we've not yet seen any sort of uptick or even surge in joblessness. So yes, one to watch, but not one to be too alarmed about just yet. And of course, on the monetary side of things, the policy backdrop continuing to ease. The Fed delivering a cut in October. My base case remains that they deliver another cut in December, and even if they don't, the Fed funds rate is on a trajectory back to neutral, and the balance sheet is bottoming out around a neutral level as well. Where do we go next then? Well, of course, it is a Friday, so you've got to question whether participants would want to chase things into the weekend, and actually I would question the degree to which participants want to chase things at all. It has been, by and large, a very, very positive year. Pretty much wherever you look, there is green on the screen year to date. The only things that aren't are the dollar and crude, and actually they're the aims of the Trump administration, so I don't think they're going to be too worried about that. Given how good of a year it's been, there is a question mark over the degree to which participants will want to chase returns, given the potential for things to go wrong into the back end of the year. Having said that, I think those forces of FOMO and FOMU, fear of missing out, fear of materially underperforming, are likely to see dips remain as buying opportunities. That certainly remains my view of proceedings. And just to end, of course, while we're talking about equity downside and how it was a choppy day, etc., 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 the S&P trades this morning back where it was on Wednesday, which is not exactly cataclysmic by any standards. And I still think there's a very, very decent chance indeed that we do print 7,000 before the year is out.